Welcome back. Today we have a slew of economic numbers related to the housing market, and I'm not sure if this is related, but the Fed funds futures actually have moved. That in just a moment. Here, new home sales, the white histogram bars, month over month. First in the center, down 9%. That's new one-family houses sold. This is the volume, down 9%. Year-over-year basis, it is up 6%. 1% up on month-over-month basis for the new one-family homes for sale. So the right chart is the inventory. The center chart is the volume, how much we've actually seen. So again, on a month-over-month basis, down 9% as far as the number of homes sold. New one-family homes for sale up 1%. We're struggling to get more inventory. On a year-over-year basis, inventory is down 5%, by the way. On the left-hand side, this is the ratio of new houses for sale versus sold, meaning inventory versus volume. So when we have a lot more inventory than what has been sold, this line will go up. Well, on a month-over-month basis, we're up 11%, meaning more homes are on the market for sale versus those homes sold. However, on a year-over-year basis, we can see inventory has fallen quite a bit. Now, here we see the blue line is the new one family homes for sale. These are the houses that are on the market. It has dropped precipitously. It's just a little bit above zero. By the way, these histogram bars, that's the federal funds interest rates. And we can see during a period of very low interest rates in 2020, 2021, this really stimulated the housing market. However, as interest rates started to rise, well, this dampened the real estate market, and it looks like it really has taken effect. On a year-over-year basis, we dropped from 35% to actually a little bit below zero. Today's number represents a little bit of a tick up, but again, new one-family homes for sale, the inventory, not good. Very, very low inventory. New one-family homes sold. This is the volume. Again, in the background is federal funds interest rates. And we can see the number of homes sold is down to just above zero. We were on a year-over-year basis up around 35% as well, but that has dampened quite a bit. The volume, this is probably one of the most remarkable numbers we've seen lately. The housing market is the volume. The volume has really dried up. Not a lot of transactions. Here's the monthly supply of new homes on a year-over-year basis. It's in negative territory. Again, the inventory is rather shallow to be certain. Now, new one-family homes for sale. This is in thousands. That's in blue. S&P 500 in red. Very strong positive correlation. Well, the stock market really took off to the upside, hitting highs near 4,800 early 22. Now, the new one-family homes for sale, that did hit a significant high about a year ago, coincidentally, right around the time that the inverted bond market began, around June of last year, maybe not so coincidentally. Now, the inventory, I know the chart looks good from a long-term perspective going back to 2015, but if we're only to take a look at what we've seen in the past year or so, this is the result of inventory really drying up. There's just not a lot of homes on the market for sale. New one-family homes sold. Again, this is the volume. That's in black. And again, the volume has also really dried up. And it really, if we take a minute to stop and think about it, if there's not a lot of inventory out there, we would think that, well, maybe the volume would pick up because, people would be rushing to the market. But between higher interest rates and inflationary pressures, we really can't afford the homes we once could. And that's why we see the combination, a very uncomfortable combination of low volume and low inventory. And this positive correlation of the S&P 500, it really kind of reverse course stocks. And this is as of last month. The numbers ratcheted to the beginning of last month. But nevertheless, we see stocks significantly stronger than where the volume is for new one-family homes for sale. This is the monthly supply. Again, this is a ratio, the ratio of new houses for sale, meaning inventory compared to new houses sold. So when we have more inventory than the number of homes being sold, when we have a lot of inventory, this black line goes up, like we saw at the beginning of 22. We saw a lot of homes on the market. Well, since 22, the January 2022, this black line has gone down, which shows us the inventory has really dried up. This is such a dramatic turn of events. Take a look at, the the COVID period of time really is kind of an unfair comparison because brokers weren't showing homes. There really wasn't any kind of activity. But aside from that, this is really probably the biggest precipitous drop we've seen in inventory in quite a long time. Now, more housing data. S&P Shiller Home Price Index on a month-over-month basis, that's in blue. The home price index was up 0.6%, year over year, 1%. 20 city home price index, that those are the 20 largest metropolitan cities, 0.59% to the upside on a month-over-month basis, barely positive on a year-over-year basis. The all transaction house price index, flat month over month, up year over year, 2.7%. So we take a look at low inventory, low volume. Well, this is the other side of the coin. High prices across the board. Top center, all transactions house price index. And we can see now we're at the fourth consecutive month, really hitting new highs we have not seen in a very long time. This only goes back to 22, but it's a long time before that we had to look back to see higher highs. Bottom left-hand side, the standard home price index, new highs, the highest highs we've seen at least going back to August of 22. 20 city home price index, new highs also. So whether we're looking at the metropolitan areas or the overall number, higher prices across the board. Now, here we see the red line is the home price index. This is on a year over year basis. The blue line is 20 city home price index. And then the green is the all transactions. Really, a very strong correlation. Of course, there is not a lot of divergence. There has been divergence. Take a look at 2008, for example. The blue line again is a 20 city home price index. The cities really took the worst of the 2008 housing crisis at that time. And then there was a lot of recovery, a lot of money coming back into cities like Miami and Los Angeles. And that did well, but we're actually very closely correlated. It really shows us that the inflationary forces have swept the board. All homes are going up in price over time. Now, not necessarily in terms of volume. These are not homes that are necessarily being sold, but the prices being marked are going up. So don't be deceived. It's not necessarily indicative that a lot of homes are being sold at higher prices. They're just being offered at higher prices. Well, the red line's a home price index on a year-over-year basis. Again, this month does represent a little bit of an uptick, but after a tremendous precipitous drop from early 2022, the blue line is a 1 year US Treasury in yield. The green line is a 10-year US Treasury. The beginning of the inverted bond market took place June of last year, June of 2022. Notice that coincided with the beginning of the drop of the home price index. This is something we've talked about again and again. But the fact of the matter is, the inverted bond market is a sign of a disjointed economic, condition that's reflected in the bond market, and that really did take something out of the economy, or it reflects something that was taken out of the economy. Now, take a look, by the way, at May 2020 through January 22. Notice how the green line is much higher than the blue line. The 10-year Treasury yield is much higher than the blue line. The blue line is very close to zero because we had zero interest rates during that period of time. Well, zero interest rates, that's federal funds rates. Closest to that is the 1 month note. Then we have the 3 month, 6 month, but then the 1 year Treasury is right behind that. So when we have zero interest rates, the 1 year Treasury stays very low. And during that period of time, that it's so easy, it's so cheap to borrow money, that's when we see economic growth. And that's why it's a very common pattern. The green line goes up, the blue line stays flat, this ascending sort of triangle. That means higher yields are going up and lower yields are staying flat. That's a sign of, a prosperous economy. And that's also something we saw, 2015 and even before that. But notice, we've talked about the bond market a lot in the past, but it's really kind of interesting. Why is the blue line now going up to meet the green line? That coincided with interest rates going up. And then eventually we had the inverted bond market. Just a slight inversion at that point in 2019. prior to the COVID crisis. But what happens is we have very low interest rates, and that creates inflation. The Federal Reserve raises interest rates, and then the blue line meets the green line. So that really is the dynamic that takes place. Here, blue line is the S&P 500. The red line is the home price index on a year-over-year basis. Again, a slight tick to the upside, but really a massive divergence. The inflation and the Federal Reserve's subsequent hiking of interest rates has really stalled out the housing market, but not necessarily stock. Lately, I know stocks actually have been quite weak. Maybe stocks, it's a lagging indicator to what we already see in the housing markets. Here's federal funds interest rates with the home price index. Just a very clear example of how much dramatic of an effect interest rates does have on the housing market. Low interest rates of 2020, skyrocketing home price index. The Federal Reserve starts to raise rates, and as we see that, the home price index really takes it on the chin. Here's a comparison. Left-hand side is 2006 through 2011. We know 2003, 4, we had zero interest rates. The Fed started to raise interest rates. The home price index came to the downside. Notice a cross below zero. That's on a year-over-year basis around the beginning of 2007, and then went into very, very deep negative territory. Well, notice where we are now. We bounced just about zero. Now, I don't know if we can fairly compare where we are now to the period of time 2007, 8. We take this period of time because it really is a tremendous example of very strong economics to very weak economics. Well, if we were to take that example, we bounced just above zero. We were around zero around the beginning of 2007. Will 2007's pattern repeat itself? Only time will tell. But watch the Shiller home price index. If we start to go into negative territory, maybe that would be evidence that we're following what we saw in '07, '08. Now, of course, we had an interest rate decision just last week. Federal Reserve keeps rates unchanged. We have another meeting coming up in November. The expectation right now is the Federal Reserve will not raise interest rates. Well, this is a Case-Shiller home price index. That's where we are right now. So actually, let's reverse that. Okay, so we have the FOMC meeting on the left-hand side. The blue histogram bars represent the chances that we're going to keep rates unchanged at the 525 to 550 level. Following the FOMC meeting last week, that was on that day, we had a 70% chance that the Fed would not raise interest rates in the November meeting, in the next meeting coming up. We had a 29% chance that they would raise rates to the 550, 575 level. Well, then we had existing home sales, Fed speakers meet, and then now today, Case-Shiller home price index and new home sales. We currently have a 16% chance the Fed will raise rates, an 84% chance the Federal Reserve will not raise rates. It is the vast opinion that the Federal Reserve is not going to raise rates for quite some time. How long, you may ask? Well, this is what the Fed Fund futures tell us right now. The chances that the Federal Reserve is not going to raise rates, again, stands right now. This is as of the November meeting. There's around an 80% chance they will not raise rate or they will not change rates. No change, around 84% chance. The chances they'll raise interest rates only 16%, just like we saw in the prior chart. The chances they'll cut rates pretty much zero. Well, take a look, and this is what the Fed funds futures tell us right now. This is a futures market that as we move forward in time, and these dates correlate with the next Federal Reserve meetings, November 1st, December 13th, January 31st, etc. And notice what happens. The red line goes down. The chances that Fed will not raise interest rates drops and intersects the chances they may actually cut rates. May of next year, May, June of next year, there's actually a greater chance, or at least an equal chance, the Fed, around 45% chance each, will either cut rates or leave them unchanged. The chances that they'll raise interest rates, the best chance for the Federal Reserve to raise interest rates what the futures market's telling us right now is January meeting, January 31st of next year. So that's where we stand right now. And the reason why we point this out is because when we see subsequent numbers coming out, we have inflationary numbers, and of course, job numbers, and a lot of other good stuff. Well, as these numbers are reported, we'll look to see how these lines kind of change and wiggle. And that will give us an indication of which way the Federal Reserve is leaning. If they're leaning towards raising rates sooner than January 31st, well, maybe that may not bode well for stocks. Conversely, if let's say inflation starts to wane and that maybe the jobs market doesn't look that good, maybe the Federal Reserve is more likely to cut interest rates sooner, then that may bode well for stocks. So all of this again eventually translates into the stock market and of course other financial markets, uh, you know, accordingly. But right now, we see that there's no chance, a very good chance, that the Federal Reserve will not raise rates until January of next year. And no chance, really, any significant chance they'll cut rates until at least May, June of next year. But we have a full economic calendar and we'll be sure to update you with any significant changes along the way. We hope this has been helpful. We look forward to seeing you back soon.